Today we're going to talk about ways that you can improve your credit score. I'm Spencer Ford, a certified financial planner professional and CEO of Conservative Financial Solutions, and let's get into today's topic. All right, so we're talking about ways that you can improve your credit score. But before you can improve your credit score, you need to first know the areas that make up your credit score. And the first area, there's 5 areas. The first area is payment history. And this far and away is the largest single portion of your credit score. It accounts for 35% of your overall score. And the thing you have to know is late payments are a disaster for your credit score. So make sure you're making those payments on time. If you've gotten off track, get back on track as soon as you possibly can. Otherwise, it's going to be extremely difficult, if not near impossible, to raise your credit score. The second is amounts owed. This makes up 30% of your overall credit score, so still a really big chunk. In addition to simply adding up the total amount of debt you have, the score also takes into consideration something called revolving utilization. Utilization is the amount of outstanding debt on your credit sources like credit cards or a home equity line of credit, anything of that nature. So if you have a credit card where your limit is $10,000 and you put $4,000 a month on it, your revolving utilization is 40%. Even if you pay the card off each month, your revolving utilization is still reported. And your utilization matters both overall and per your credit score or credit source. So it matters cumulatively and then per credit source as well, just to clarify. So if you want to improve your credit score, you want to consider lowering your revolving utilization. Maybe you increase the limit on your credit card to $20,000 if you're able to. Now you can still spend $4,000 a month and pay it off each month, but now your revolving utilization is only 20% as opposed to 40%. And the recommendation is really to keep your revolving utilization below 30%, but those with the highest credit scores tend to have revolving utilization of 10% or less. The third category when determining your credit score is length of credit history, which makes up 15% of your score. What are the ages of your accounts? What's the average age of all of your accounts combined? How long has each individual account been opened, or when was each individual account last active? All of these questions matter when determining your length of credit. If you have no credit history, you might consider getting a credit card, charge a little each month, keeping your revolving utilization below 30%, and make sure you pay it off each month. There's no reason to rack up debt just to improve your credit score. The fourth category is new credit. This makes up 10% of your credit score. So when you apply for new credit, whether that be a new credit card, a loan, or line of credit, the lender checks a copy of your credit report. This is known as a hard inquiry and appears on your credit report for 24 months. Some inquiries may hurt your credit score for up to 12 months, but either way, others can be ignored. So some are going to affect your credit score for 12 months, others can be ignored. But here's a tip. If you know you're going to be shopping for multiple loans, you want to bunch them together. For example, if you're applying for a new credit card, but you know you're going to be refinancing the house, or maybe you're applying for student loans, or you're getting ready to purchase an automobile, plan ahead so you can keep your rate shopping within 30 days. You want to make sure that an inquiry made from one potential lender doesn't lower the score for what the next lender might see. So FICO scores, which is one of the reporting agencies for your credit score, those inquiries that are made 30 days prior, those aren't going to count against you when another lender sees it. Now, however, there's some older scoring models that they're going to look at inquiries within the past 14 days. So the more you can bunch those together, the better. The fifth category that determines your credit score is credit mix, which makes up the last 10% of your credit score. This score is based on the types of credit you have. So do you just have credit cards, or do you also have a mortgage, retail accounts, auto loans, and more? So to recap, the 5 categories for determining your credit score are payment history, amounts owed, length of credit history, new credit, and then your credit mix. The first two, payment history and amounts owed, combine for 65% of your credit score. So make sure you make those payments on time and try to keep your revolving utilization below 30% if you can. Here are some other tips. If you pay off a credit card, think twice before you close the account, as that can negatively impact your credit score. So closing a line of credit can increase your revolving utilization, and it can also reduce your average length of credit. So those could both of those things could damage your credit score. If you're retired, please pay attention to this. Be sure to check your credit score. If the house is paid off, the credit cards are paid off, maybe you don't use credit cards at all, or you don't use credit, you could end up not having a credit score or a very low credit score. I've seen far too many retirees get denied for loans because they have no credit. They might have $5 million in their retirement accounts, but they can't get a loan because they don't have a credit history. They want to buy a condo in Florida and they can't because the banks won't even talk to them because they don't have a credit history. So it's always a good idea to keep a few lines of credit active in case you want to apply for a loan in the future. Thank you for watching this video. Hopefully you find it helpful in improving your credit score or keeping your credit score active. Again, my name is Spencer Ford, and we'll see you in the next one.